Hi, I'm Jonathan Wild, and today we're covering how to compute return on assets. Return on assets, or ROA, is essentially a way to gauge how well a company is using its assets to generate net income. To calculate return on assets, we take net income and divide it by average total assets. Net income is taken from the company's annual income statement, while average total assets is calculated by adding up the total assets at the start of the year and the end of the year, and then dividing by 2. Let me show you how this works. Assume a company reported net income of $72,000 for the current year. Total assets at the beginning of the year were $320,000, and at the end of the year, they were $400,000. To get average total assets, we take the $320,000 plus $400,000 and divide by 2 to get $360,000. Now, to compute return on assets, we take net income of $72,000 and divide it by average total assets of $360,000 to get return on assets of 0.2 or 20%. But what does a 20% ROA tell us about the performance of the company? Well, one way to determine this is to compare it to the ROA of a competitor. So let's say a competitor has a 15% return on assets. Which company is doing better? Well, based on return on assets, the company with 20% is doing better, as a company would prefer to have a higher return on its assets. Overall, return on assets is a great tool to understand how effectively a company is using its assets to generate profits.